You know, when a huge company decides to build a new factory or launch a brand new product, they're not just spending money. They are literally placing a bet on the future, a bet that can make or break the entire organization. Today, we're going to pull back the curtain on the structured process they use to make these massive calls. It's a discipline called capital budgeting, and we're going to break down exactly how it works.
I mean, it really all comes down to this one question, right? When the numbers have that many zeros on the end, you just can't rely on a gut feeling or hope you get lucky. So, what's the secret sauce? How do you stare into a totally uncertain future and still make a decision with real confidence?
Well, the answer is a process. It's a methodical, disciplined way of thinking that forces you to challenge your own assumptions, to figure out what the real costs are, and to stress test your ideas before a single dollar of that billion-dollar budget is even touched. It's not about having a crystal ball, it's about building the best possible map.
And that map, well, that's capital budgeting. It's the official, rigorous process for looking at those huge, long-term projects. And make no mistake, these are the kinds of decisions that will define where a company is going for years, sometimes even decades to come.
Okay, so how does a journey like this even begin? It all starts with cash, but not just any cash. We've got to find the real cash, the money that's directly tied to the project. And that means learning to see what actually matters and what's just noise. The entire analysis, the whole shebang, hinges on this one key idea: incremental cash flow. This is the bedrock of everything. We are not interested in the company's total profits. Not at all. We only care about one single thing. How much more or less cash will the company have in its pocket if we do this project versus if we don't? That's it. It sounds simple, but, oh, there are some tricky parts.
And here are the two biggest traps people fall into. On the left, you've got sunk costs. This is money that's already been spent, it's gone, poof. And yeah, it might hurt, but it is completely irrelevant to what you should do next. You have to ignore it. Now, on the right, we have opportunity costs. This is the complete opposite. It's the value of the road not taken. And you absolutely 100% must include it, even if no actual cash is changing hands.
This quote just perfectly captures the sunk cost fallacy in the real world. So back in 1971, Lockheed had already poured $1 billion into its TriStar airplane project. They actually argued that it would be foolish to stop because of how much they'd already invested. But here's the thing, that $1 billion was gone whether they finished the plane or not. It was a sunk cost, and focusing on it just leads to throwing good money after bad.
And this slide gives us a perfect way to think about an opportunity cost. So, let's say you want to use a factory you already own for a new project. You might think, awesome, the building's free, but it's not. The real cost is the cash you're giving up by not selling that factory or by not renting it out to someone else. That money you're foregoing, that's a very real incremental cost to your project.
Okay, so once we know what kind of cash to look for, our next challenge is to actually estimate it. And this is where the map making gets really, really tricky, because we are literally trying to chart a future that hasn't happened yet.
And believe me, the stakes could not be higher here. You can have the most advanced, sophisticated financial models in the entire world, but if your forecasts, your estimates of future sales, costs, and prices are garbage, then your final decision will be garbage too. It's the classic garbage in, garbage out problem.
So how do we actually do this forecasting? Well, it's really a mix of art and science. You've basically got two main flavors. On one hand, there are quantitative methods, which use historical data. These are fantastic if you're in a stable market where the past is a pretty good guide to the future. On the other hand, you have qualitative methods, which rely on expert opinions. These are absolutely essential when you're launching something brand new and you have no past data to even look at.
The Delphi method is a really cool example of one of these qualitative techniques. Instead of just putting a bunch of experts in a room where, maybe the loudest person wins the argument, you survey them all anonymously. Then, a neutral facilitator summarizes the results and the reasoning behind them and shares it back with the group. People get to revise their forecasts based on what everyone else thought, and you just repeat this cycle until the group's opinions start to converge. It's a really smart way to distill wisdom without all the politics and groupthink.
This is the question that should keep every single manager up at night. Because let's be real for a second. No forecast is ever perfect. The future is, by its very nature, uncertain. So, what do you do about that?
Well, we don't just cross our fingers and hope for the best. We actively prepare for the worst. We give our project a really tough stress test. Think of it like a financial health checkup to see how it holds up when things don't go according to our perfect plan.
And a key tool for this is something called sensitivity analysis. The idea is actually simple but incredibly powerful. We take one key variable at a time, let's say the selling price of our new product, and we just wiggle it. We ask, okay, what happens to our project's value if the price is way lower than we expect? And what if it's way higher? And this table right here shows you the result of that wiggling. Now check this out. Notice that huge swing in value when we change the unit selling price. The project's value goes all the way from a positive $1 million in our likely scenario to a negative $1.2 million in the pessimistic case. Wow. Now compare that to the initial cost, which barely moves the needle by comparison. And just like that, the analysis basically screams at you, showing you the project's weak spot, its Achilles heel. In that last example, we learned that the project's success is incredibly sensitive to whatever we set as the selling price. That's the one variable we need to worry about the most, research more, and maybe even figure out ways to protect ourselves against.
So, we found the real cash, we've forecasted the future, and we have stress-tested all of our assumptions. Now, it's time to bring it all home and make the final call.
See, a great project isn't just about getting a positive number on a spreadsheet. The final decision has to bring in these other qualitative factors. How does this project fit with our brand and our public image? What's the environmental impact going to be? Could we run into legal headaches down the road? These are huge strategic questions you just can't ignore.
And this creates this really powerful feedback loop. The results of one project's analysis don't just live in a forgotten folder somewhere. They actually feed back into and inform the company's bigger, grander strategy. A super successful project might signal a whole new direction for the entire company, while a failed analysis might force everyone to go back to the drawing board and rethink everything.
So let's just quickly recap our whole journey. At its core, capital budgeting is all about focusing only on those future incremental cash flows. That means you have to learn to ignore sunk costs while always including opportunity costs. It means you use a mix of art and science to predict the future, and then you stress test those predictions to find your Achilles heel. And finally, you always remember that the numbers are just one piece of a much larger strategic puzzle.
At the end of the day, this whole process does way more than just approve or reject projects. It's the framework that companies use to consciously and deliberately build their own future, one massive decision at a time. It turns what could be a risky guess into a calculated step forward. So the real question isn't just about which project to choose. It's about what kind of future you're trying to build.